And right now, let's welcome our first guest, Dennis Gartman, the editor and publisher of the Gartman Letter. He's also a CNBC contributor, and you've probably seen him in the financial media discussing commodities and the capital markets. He's also chairman of the Akron University Investment Committee, serves on the investment committee at the North Carolina State University, and is a member of the Suffolk Industrial Development Authority. Dennis, thanks so much for joining us today right here on The Income Generation.
Glad to be on. You guys were scraping the bottom of the barrel, and there I was.
Well, heck, we had to wait till you halfway retired just to get you, for goodness sake. So now that we have you here, we're going to keep you for a few segments. I don't plan to let you go anytime soon. Today, as you know, we're talking about stock market indices. And as you probably are aware, most average investors don't really understand the different indices, why they're different, how they're weighted differently. But I'd like to ask you from a layman's perspective, if for your average investor out there, your average member of the income generation, what do you think people need to know about indices? To what extent do you tell them to follow indices as a base of comparison of her performance? And which extent do you say really, be careful, don't overdo it?
Well, I guess the most important thing is the first one that everybody hears is the Dow, which is only 30 stocks. And it's by that definition, it's awfully finite and it's awfully small. It doesn't reflect very well on what's going on as far as high tech is concerned. The next one that everybody is aware of or should be aware of is the S&P. It's obviously 500 stocks, far broader in orientation, far more representative of the economy in general. The next one that everybody should pay attention to is the NASDAQ, which is even broader than is the S&P, and probably far more representative of the of high tech, for lack of a better term. And back at the turn of the century, owning the NASDAQ, owning the NASDAQ, being short of the S&P was the trade of the decade for a while. And finally, there's the Russell, which is a much even broader. It's 2,000 stocks, and probably most representative of all, but the least liquid and the one that the public is least aware of. Then there's always the DAX index in Germany, the Nikkei in Japan, the CAC 40 in France. So each of the countries has their own indices, but the ones that we're probably most interested in are the Dow, which is narrow, the S&P, which is wider, the NASDAQ, which is wider still, and the Russell, which is the widest of all.
So in the 1 minute we have left in this particular segment, tell our viewers, if you will, what do you think some of the limitations are here? Because people get so fixated comparing performance in their portfolios to an index. So how do you keep them from getting overly fixated on this type of thing?
I wish I could answer that question as well as I could, because as the chairman of the University of Akron's endowment and now 15 years on NC State's endowment, we fight all the time over which index we're going to be indexed to. And in the great scheme of things, you're probably going to get angry at me for this, but the difference between the Dow and the difference between the S&P and the difference between the NASDAQ over any broad period of time is really going to be relatively minimal, to be bluntly honest. I think for the retail clientele, they really shouldn't they really shouldn't delve too deeply into the differences between one index and another. Just again, they represent broader indices, broader representations of the economy. But whether in a bull market, they're all going up together. In a bear market, they're all going down.
Yeah, in general, they do tend to track each other a lot over the long run. So, Dennis, if you could stay with us, please. We need to take a quick commercial break. You stay with us, too. We'll be back here in a moment with more on the income generation. And right now, let's welcome back Dennis Gartman, editor and publisher of the Gartman Letter. Dennis, thanks for sticking around.
Oh, honored to be asked. The fact that you put up with me for 4 minutes already is astonishing.
Hey, so were you surprised about the market's performance last year? I mean, particularly toward the last couple months of the year, or not really?
Yes, really. I was astonished by the market's performance last year. You have to remember that in October, November, December of 2018, things went into the dinger so quickly, and it had the appearance. I mean, the stock market is a presager of what goes on in the economy, and it looked like we were heading for a recession. The Fed was beginning the process of tightening monetary policy, and all of a sudden, I mean, things really looked quite ill. The fact that we turned around as quickly as we did on a dime caught me off guard. I think it caught every professional off guard. And most of the pros underperformed the stock market in general. It was a stunning, surprising, shocking, and absolutely amazing performance. Are we going to see that again? Probably not in my lifetime.
Yeah, and all in spite of a flat yield curve, right? We had good flat yield curve for at least 6 weeks during the summertime.
In spite of an inverted yield curve for a couple of days in the middle of the summertime. I mean, that really got everybody very disconcerted.
And it seemed like the Fed jumps in, they start buying back Treasury bills on the short end of the curve to right side the yield curve and pretend like it never happened. And it seemed like the markets bought it. So I guess the question then is, how about this year? How about 2020? Do you think that with it being an election year, with this concept of not fighting the Fed and the Fed seeming to be more accommodative now, do you think that we could squeeze one more good year out of it? Or, what are you telling people?
Let's understand that it's not just the Fed that's becoming far more accommodative. The Bank of England is becoming more accommodative. The Bank of China is clearly becoming more accommodative. They've actually cut reserve requirements, which is, I've always said, there's nothing more potent in the equities market and nothing more potent in the interest rate market than a cut in the reserve requirements. It's the 2x4 to the mule of the economy, and the Bank of China has done that. The Bank of Japan is becoming monetarily easier. So this is something that's going on around the world, and as long as the monetary authorities are becoming expansionary in their policies, you don't fight the Fed, you don't fight the Bank of China, you don't fight the Bank of Japan, you don't fight the Bank of England. It is amazing to me that stock prices are as high as they are. By any valuation, they are overvalued, but as long as the monetary authorities are expanding, you have to say the bull market will continue. Shocking, but true.
So if you had to make a guess as to when perhaps we slip into the next recession or bear market cycle, do you think perhaps 2021 after the election? Well, what would your best educated guess be? And I know it's just that, a guess.
We are so long overdue for a recession of some consequence. And the next recession that we get will not be anything approaching what we went through in 2007, 8, and 9, because we don't have the bubble other than the equities market. And the monetary authorities will be the very first to come back and become, again, more expansionary. But when will a recession hit? I don't think there's going to be one in 2020. And you're probably right. It'll probably be after the presidential election and on into 2021 before there's any sign of weakness. The only caveat I will give to that is that my favorite index as far as the economy is concerned is the conference board's leaders, and the leaders have been down now 3 months in a row, and you have to pay attention to that fact. Doesn't mean they can't turn higher, doesn't mean that can't be ineffective, and we've had non-recessionary periods when the leading indicators have been down for 3 months in a row previously, but the fact that they've been down for 3 months in a row is to me quite bothersome.
10 seconds. Next recession, do you think we'll see negative interest rates here in the U.S.?
I'm afraid we shall. It's frightening. I cannot believe that we're already there in Europe as we are. But I'm afraid that we're going to probably take it to negative interest rates. Shocking though it might seem, the rest of the world has gone that way. We probably shall follow.
I wouldn't be surprised. Dennis, we need to hit one more commercial break. We'll be back in a minute. And you don't go anywhere. You stay with us. We'll be back here in a moment on the income generation. Now let's welcome back for one final segment, Dennis Gartman, editor and publisher of the Gartman Letter. Dennis, I have to tell you, it was with much sadness that I heard the news about you ending the Gartman Letter as of the end of last year. Tell us, what brought you to do that, and what stands in your future for our good friend, Mr. Gartman?
Well, after 35 years of getting up at 1 o'clock in the morning to knock out 5, 6, 7, 8, 9 pages every day that I hope was insightful, that had a good geopolitical overview, that had a good overview of what was going on with the monetary authorities, that had a good overview of energy, that had a good overview of the grain markets. I always cast myself as the liberal arts major of the capital markets. I knew enough about each one to speak to each individual area. And after 35 years, quite honestly, my hands were getting a little tired. My mind was getting a little tired. I was getting a little tired. And in 35 years, I missed 3 days. One from my celebrating my parents' 50th wedding anniversary, one because of a hurricane, and one because of a kidney stone. Don't get a kidney stone. Avoid them if you can.
I will take that advice if I have anything to do with it, for sure. So what's your next chapter? I mean, I'm sure you're not the person who goes from 1 o'clock in the morning every day for 35 years into full retirement. What's next?
I'm going to start writing a bi-weekly just to keep my fingers in the pie. I'm going to do a couple podcasts, 1 or 2 a week, just to keep my fingers in the pie. I'm trading from my own account, so I'm obviously in the market every single day. I'm watching the markets probably even more efficiently and effectively than I was before. So no, full retirement is not on the horizon. I'm still up and kicking, so I'm probably going to be around for a while longer. It's just that I did grow weary of getting up at 1 o'clock in the morning and only getting 3 hours sleep a night. That grew wearisome.
Oh, I can only imagine. And hey, even a kidney stone only kept you down for a day. So, so what do you hope in your heart of hearts that your readers have gotten over the years from your newsletter?
A couple of things. One, the very simplest rule of trading and investing is a rule that is good in life. Do more of the things that are working and less of the things that are not. If you buy a stock at 10 and it goes to 15, buy more. The market's telling you that you're right. If it goes to 5, don't get out, maybe. I would say get out, but don't do more of that. Don't average down. That's the most important thing. So do more of that which is working and do less of that which is not. That's the most important thing I think I've gotten across. 2, some of the economic indicators, pay no attention to the trade deficit. It is not terribly important. In fact, as the trade deficit has gotten larger, the United States has gotten stronger. And I've been told for years and years that we can't have the trade deficit get wider. It'll be detrimental to the economy. It's just not true. And 2, markets can go farther than anybody ever believes possible. As the great Lord Keynes once said, the market can remain illogical far longer than you or I can remain solvent. My corollary to that is that the market will return to rationality the moment you have been rendered insolvent.
Well, and frankly, the market staying irrational longer than we could have expected is part of what's happening right now, because this market blow-off, as I call it, as of the last few months, has gone on a lot longer than either you or I have expected. So in 45 seconds we have left in this segment, as you know, our income generation show is mostly for those who are retired or within 10 years of retirement. What are the best words of wisdom you can give to those folks watching you today?
It's a bull market in stocks. It will probably always be a bull market in stocks here in the United States. Buy good companies that have long-standing dividends. If you're retired, that's probably the best instance of all. And take a look at some of the ETFs that have dividends that pay dividends on a monthly basis. There are I shouldn't say hundreds, but there are certainly dozens of them out there that yield 6, 7, 8, 9, 10%. And people are not paying enough attention to them and should.
And in today's environment, you can get 4% dividend on blue chip value-based stocks without even being a bottom feeder. So I think that's really good advice. And Dennis, congratulations on semi-retirement, and thanks so much for being on the show.
Thanks for having me on. It's been an honor to be here. Good luck, and as I always sign off, good luck and good trading.
All right, it's been great having you, my friend. You stay with us too. We have more coming up right here on the Income Generation in just a moment.